what do you think this actually means?
Look, I think there's no question that the Delta virus is taking a toll on the economy. What's interesting is how much tinier that toll on the economy is than the toll it's actually taking on health. We're headed pretty rapidly to daily death toll from Delta that exceeds the death toll that we had in April from the first wave. But then you look at these numbers, Delta maybe subtracted, 600,000 jobs that we would have had absent Delta that we didn't have. Last time around, we lost 20 million jobs. Delta's having about 3% as much impact on the economy as the first wave of the virus did. Labor markets are still pretty tight. There's more than 10 million job openings. Job openings keep rising. One of the big data points this month was wages, up 0.6%.
Right.
That is a tight labor market with a lot more openings than unemployed. And that also means we're poised to add a lot of jobs in the coming months as people either get over their fears of Delta, the Delta virus starts to fall, or time starts to fix all of this.
Hey, Karen, I've been saying all week that I wasn't sure we should read too much into these numbers because the two things that we've been saying would really get people back to work have been schools opening and the extended unemployment benefits ending. And neither of those things really are happening until right now, a couple weeks after when this survey took place. How much can you say, okay, let's just wait another month and we'll see what really happened?
So I actually think it is a waiting game. I think for the Fed, I think time's on their side. They can continue to wait. I think it's likely to be later in the year before they start to make a move on tapering. And they don't have to rush, in my opinion. I think inflation will also subside eventually. So they don't have to rush to make the tapering move. And in terms of the labor market healing that we'd like to see, that's also a waiting game because a lot of the action that we're seeing, and by the way, there's a lot of action, a lot of turn, a lot of job transitions. These are largely from people who have a job and are jumping to a job with, say, more flexibility or more wages, as we're seeing in the data. What we haven't seen yet is people coming off the sidelines as much as we would like. It's starting, it's continuing, but I don't think that full pull will happen until we know kids can stay in school 5 days a week, until we see the effects of the unemployment benefits maybe being pulled away after a couple of months. I mean, the labor market's complicated, and it's going to take a couple of more cycles before we see the full healing. But I do think we're on the course for recovery. There's no doubt about it.
So, Kate, from a stock market perspective, what does this mean? Does this change anything that you would be telling investors right now?
No, not really, Becky, because I actually think we've been really focused on this theme of supply side challenges to the further economic recovery instead of the demand side. And I think that's really kind of playing out here in the labor market as well. Heard Neela talk about the bus drivers. We just don't have supply of the workers. We don't have supply, whether it's in the supply chain or inventories across a variety of different industries. This is something that companies have been talking about consistently over the course of the summer. They've talked about it during earnings calls, when they've communicated with investors at other times. And there does really seem to be a limitation, or at least a headwind, to progression in economic growth due to supply side constraints. If it was demand side, I think I would be more worried and more concerned about how the equity market would interpret it. But for right now, as long as we know that we'll be able to work through some of these issues over coming months and quarters, I think some of the supply chain stuff, for example, in semiconductors will take quarters, not just months. As long as we can work through that over the period, going into the end of the year and the beginning of 2022, the equity market should look through this. We still see upside to the equity market through year end. And I'm actually quite constructive on the asset class, over the next 2 months.
Hey, the equity market's not doing much, but Rick, I see you kind of signaling this. Rates are going up a little bit. I think I saw 1.32 for the 10-year.
Yes. Rates have done a U-turn here, folks, from a couple of basis points under 130 to 132. 30-year bond yields have zoomed up to 194, so they're up 4 basis points. And to me, maybe they're all watching the show because this is exactly the discussion traders need. How much impact this is going to have on the ultimate timeline, and I think we can tell. Plus, a 3-day weekend where equities are very close to all-time highs. But pay attention here. Should they push these rates all the way back above 1.37%, that would be significant. I don't think it'll happen, but that's the level to pay attention to on 10s. The level on 30s is 2%.
Meaning that traders are kind of watching and thinking through things and thinking, okay, despite this weak number, it probably is not going to impact the timeline. We're probably going to see the start of tapering happen on that same time frame.
Yes, I think that's exactly what traders are thinking. They're thinking that the Federal Reserve is ultimately going to move on, of course, but continue to keep an eye on the variant. But that gives them a couple of months, and that's the way traders, I think, are approaching it. They're going to continue to probably do the plan, continue with the plan, although there's going to be a small asterisk. But the 3-day weekend, I think, is putting the asterisk kind of off to the side.
But maybe it's the wage thing. I mean, you know, there's two components to inflation, right?
Absolutely. Yeah, I couldn't agree more, Joe. I think that and the year-over-year and the month-over-month numbers, as Jason Furman also pointed out, these are fairly aggressive numbers on the wage component on the earnings.
Jason, you did mention...
I would have to jump in here
Go ahead.
because where we're going to see the gains, the industries and the jobs that are most poised for gains in the second half of the year are those low-paying jobs that were lost. So it's very likely that wage growth declines as these jobs come back and more people come into the labor market. It could be just the artifact of the composition of jobs that are out there now, not really reflective of what would be needed if we were to see a fulsome labor market recovery, which means getting those low-paid jobs back into circulation.
Shepard Smith here. Thanks for watching CNBC on YouTube.